If you own high-yield ETFs such as ULTY or MSTY, you already know how exciting it can be to see frequent, often very large distributions hitting your brokerage account. But a question I get all the time is, what should you actually do with these dividends? There are many things that you can do with these dividends. Should you reinvest them, use them as income, or move them into safer or even different types of assets? In today's video, I'll walk you through some main strategies for putting these payments to work, plus some important tax considerations to keep in mind. Let's dive right in. So first, let's do a quick recap on ULTY and MSTY. What exactly are these funds and how they pay a high distribution rate, often very close to 100% or even far exceeding that depending on the volatility. MSTY is the YieldMax MSTR Option Income Strategy ETF. It's a single stock ETF and it has a synthetic covered call position, which is allowing it to generate this massive distribution rate, currently about 88%. And this is because the underlying stock, MSTR MicroStrategy, is a very volatile stock. So the higher volatility we have with the underlying, the more in option premium we're able to generate. So we're able to see it has an 88% distribution rate, and something like Apple that has an option income strategy ETF, it's not as volatile, so we don't have as high as a distribution rate, and that one is only about 20 to 30%, which is significantly lower. And that is why MSTI is one of the most popular YieldMax option income strategy ETFs. It pays a very high monthly distribution, and it's very popular for good reason. ULTY, on the other hand, is the Ultra Option Income Strategy ETF. Very different investment vehicle than MSTY, has a very similar distribution rate as MSTY has had a lower distribution rate from the last distribution months because of lower volatility, but ULTY is a different beast. It has almost 30 different underlying holdings, so it is diversified. It actually holds the shares now, and that is why it's been so popular as of lately. They've changed the strategy. They've made a ton of different changes that have been beneficial for ULTY. Some are including holding actual shares versus MSTY. It's a synthetic covered call position. They don't actually own the underlying stock, but ULTY holds the shares, and it did change from a monthly to a weekly distribution schedule, which has also made it very popular for income seekers. You get the money more frequently up front, and you can use that money for whatever you want, bills or just reinvesting a little bit quicker. And if we take a look at ULTY's share price, that is something we do have to take into consideration. We can see how stable it has been over the past month since the strategy change, and that is because they also have protective puts in place in case the underlying stock drops significantly. One of its holdings was actually HIM's stock, which has dropped a significant amount, and they had a protective put in place which protected the ETF from dropping a huge amount. So those protective puts have been able to be utilized to stabilize its NAV and has kept a lot of investors very happy. Now we do have to note that with all these dividends or distributions, you are going to run into some taxes because we do have to pay taxes on all of these dividends, and they are not going to be treated as normal dividends from a company because of its strategy, which is option premiums. Some of the distributions are going to be treated as return of capital, which means you're not going to be taxed on that immediately. But you should assume that you're going to have to pay income taxes on every single distribution. It's better to be safer than sorry when tax season comes around. And that is actually going to be one of our first talking points. It's to actually set aside some of the money, preferably 20 to 30% that you're receiving in distributions, and place them in a treasury bond ETF such as SGov, a very safe investment to park your cash. I treat it as an equivalent to a high yield savings. I personally have all the cash I need for taxes in this account, in this ETF, as well as my full emergency fund, because it does have a higher dividend yield than a traditional high yield savings account. And you're not locking up your money as you would with a certificate of deposit. And another benefit is because it's holding these treasury bills, you do not actually have to pay any state taxes on any of the interest earned from this ETF. Right now, the distribution rate for SCUP is currently slightly above 4%, whereas a high yield savings in Capital One is about 3.5%, and even less with a certificate of deposit, and your money is locked up. Now, the second way to use your dividends wisely is to actually move your dividends into another ETF class, such as SCHG, which is a large cap growth fund. A lot of people are buying these income ETFs to fund their growth portfolio or even some other stocks that they want to purchase. SCHD has been phenomenal for growth focused investors such as myself. I personally own a ton of SCHD in my Roth IRA, so I can let it grow tax free. Another ETF you cannot go wrong with is an S&P 500 ETF, such as the Vanguard VOO, one of the most popular ones out there, and it has a very low expense ratio of only 0.03%. This ETF just holds the top 500 companies in the United States, so you can't really go wrong. We have top companies such as Microsoft, Nvidia, Apple, and Amazon. And it does actually pay a dividend, only 1.22%, and it's a quarterly payment, but you're not really buying this ETF for its dividend yield. While it is a nice bonus, we are mainly holding this ETF for something that's a little bit safer as an equity, as well as that growth that we can see over the past few years. And for safer investors, SCHD is a great choice. It hasn't been doing too well over the past few years. We can see the stock price has been a little flat, but it does pay out almost a 4% dividend yield, and it is quarterly holdings. But this is a very defensive ETF, someone who wants to take something that people would consider risky, such as ULTY or MSTY, and place that into something that is very safe in this space, which is SCHD. And it does have very good returns by letting your dividends compound, but it is a slow grower compared to some of the other growth ETFs. And this is perfect for people who want to be more conservative as time goes on, so SCHD is a great place to invest in. Now, I'm a huge fan of the NEOS ETFs, and one of the ones that has won an award of the year from ETF.com was QQQI, which is the NASDAQ 100 High Income ETF, pays a dividend yield of about 14%. And this is one ETF that I'm personally using some of the dividends from MSTY and ULTY and investing and buying some shares of QQQI as time goes on. We can see it does have pretty good share price appreciation as well. And that's one advantage QQQI has over an ETF such as JEPQ. It does recover better in markets, and they do a lot better with their fund managers at having that upside potential, which we don't really see with a lot of other ETFs. And this does have a monthly payout frequency. It pays out about 60 cents per share on average, so it's going to be a 14% dividend yield paid out monthly. And because of the 1256 contracts that they are utilizing, it does have better tax treatment. 60% of the dividends you're receiving is going to be taxed as long-term capital gains, and only 40% is going to be taxed at short-term gains. So that's why this is one of my favorite ETFs. I'm constantly buying more and more shares with the dividends that I'm receiving from these higher yielding income ETFs, such as MSTY, something a little bit more safer and stable as the backbone of my income portfolio. And lastly, the most popular strategy is simply dividend reinvestment. Use every single dividend to reinvest back into the fund, and that can actually compound even faster and snowball your portfolio. If we take a look at the total return in the past year, it's up 12.75% compared to the S&P 500. It's actually beating the S&P 500 in the past year, considering they didn't even have that strategy change until March of this year. So we can see the share price went from $13, $14 per share all the way down to $6.22 per share, and is beating the S&P 500 despite this 54% drop in share price, which is kind of crazy to think about. Now, if we take a look at the dates and change it from when the strategy changed, which was of March of 13 that week, so we'll do March 10, 2025 and apply it to now, it's up 26% total return compared to the S&P 500, which is only up About 10%. So this is all with dividends reinvesting, and we can see how much compounding effect really has, because every time you use those dividends and buy more shares of the same stock or ETF such as ULTY, you're going to have more shares, increase your dividends every single week, and with that weekly compounding effect, it's really going to snowball your account. Now we do want to keep in mind that there are some tips for managing high yield income. You want to avoid over concentration. You don't want to have your full portfolio into something such as MSTY. While it's a great fund, one of the most popular ETFs out there, pays an insanely high dividend yield, you do want diversification. Don't let this tempt you to putting 100% of your portfolio into one of these ETFs. You want to constantly have a balanced portfolio in case anything does go wrong. And of course, you want to manage these funds, especially MSTY and ULTY. As we saw with the ULTY, they had their strategy change. You can't really consider this as a single ETF that has been performing poorly, because the past few months, this has been one of the best performing ETFs out there. And if MSTY's strategy does end up changing, or the strategy doesn't work anymore, say the ETF goes from $21.40 per share all the way down to $10 per share, and the dividends drop from $1.47 all the way down to, let's say, 25 cents per share. Obviously, that's not going to be appealing. You want to monitor these ETFs. They're going to be volatile. The dividend payments are constantly going to be changing based on volatility, as well as the fund manager's performance. So you constantly have to manage and monitor how these are performing on a daily basis. And be careful if you're using margin on these types of funds. I personally would do something safer like SPY or QQQI, as we mentioned earlier. Those funds are some of my favorite ones. They've been consistent, reliable, pay a high dividend yield, and they are paying out every single month. Now, to recap, you have three main strategies for managing the ULTY and MSTY dividends. You can simply reinvest them, compounding your wealth over time, increasing your cash flow. The second one is diversify, using the payments to build a more balanced portfolio. And the third one is to use them as cash flow to fund expenses or supplement your current income, pay bills. And that's the main reason people are using them. They're not using them in Roth IRAs. They're using them in taxable brokerage accounts because they want to use that income for paying bills and expenses immediately, especially in this tough economy, tough job market. A lot of people need to supplement their income and use it as something to fall back on if they end up losing their job. This will help them with that cash flow. So which strategy is right for you depends on your risk tolerance, your income needs, your tax situation, and your long-term goals. Let me know down in the comments what your strategy is. Are you reinvesting? Are you paying bills with them? Or are you moving them into other assets such as VOO or other growth ETFs?